There continues to be a lot of talk about the potential of a housing market crash. Now, some of this is based on pure opinion, and some of it is based on nothing but fear or the idea that what goes up must come down. And I'm not going to argue with that, but in today's video, I want to go through the five main causes of an industry crash. Now, I'm talking any industry, the five main reasons that an industry or a market crashes. Hi, this is Andrew with the Andrew Smith team at eXp Realty. And if you've seen some of the videos I've done over the last several months, you'll know that we've talked about the idea of a market crash quite a bit. And last year, there was a lot of talk about a crash. The pandemic was going to cause housing to crash. And in the past year, it has done anything but. As a matter of fact, it took off, and it's had some of the best years it has had in the last 15. So what was speculated back then didn't come to fruition. But as I mentioned, what I want to do today is give you the five main causes that industry, or the five main reasons that industries crash. And I'm going to relate that back to the real estate market that we're experiencing today. All right, so number one, an item or a service becomes obsolete. Now, in this case, I want you to think of Blockbuster. Okay, so remember Blockbuster Video. They were the big kids on the block. As a matter of fact, they actually had an opportunity to buy Netflix and passed because they didn't see the long-term opportunity in it. And we all know what happened, right? The video store on the corner where you go and rent movies disappeared. That business model became obsolete. So how does that relate to housing? Well, I think we can all agree that housing isn't obsolete. Everyone needs a place to stay. And as a matter of fact, the pandemic actually increased the demand or the desire for housing, so to speak. As a matter of fact, in a recent survey done by Unison's, 91% of all homeowners surveyed said that home represented a sanctuary, a place of peace, and gave them a higher level of comfort. So that percentage has actually gone up. So I think it's safe to say that in this particular instance, housing has not, and there's no indication that it is going to become obsolete unless something drastically changes that we're unaware of at this time. All right, item number two, the demand for an item or a service drops dramatically. So let's go back here and let's look at the restaurant industry or hotels, so the service sector. So when the lockdowns of the pandemic went into place, what happened to demand for eat-in restaurants? It dried up, it disappeared. There was no demand. And as we all know, unfortunately, many restaurants didn't survive COVID. They went out of business. Now, as I just mentioned, just a second ago, that's not happening with housing. I think that we've seen that demand for housing has gone up. The desire for home ownership has actually increased. And it's caused the market that we're experiencing today. Very high demand with low supply is brought us to the position that we're in. And that demand isn't going anywhere, that we can see right now. All right, so number three. Actually, I'm going to stay on number two for 1 second. I've got a quote here from Bill McBride with Calculated Risk. And as any of you know that have watched this, I reference Bill quite a bit, as he's always got some good things to say. And I just wanted to include this. Sales, not seasonally adjusted, but total sales in September were 2.7% below sales a year ago. So September 21, sales were down 2.7% compared to 2020. Now, as I mentioned in last week's video, you can't sell what isn't for sale. And the amount of homes available for sale has gone down. So that has impacted the numbers. But when you exclude September of 2020, sales this year were the strongest September since 2005. So again, safe to say demand hasn't gone anywhere. And as a matter of fact, it has actually increased. All right, number three, demand for an item or service is artificially generated. Okay, so what would cause demand to be artificially generated? In this case, we are going to use real estate as an example. And if any of you recall, if you go back to the market in 2005, 6, and 7, before the period when it crashed, demand for housing was artificially generated by the mortgage industry, right? So what I mean by that is all of those type of loan programs came out that were not based on anything. They became known as liar loans. So they took a look at credit, and the guy, mortgage officer he spoke to would say, "Do you make money? Yeah. Do you have a job? Yeah. Do you have money in the bank? Yeah. Okay, your loan's approved." You didn't have to supply any proof, no tax returns, no bank statements, no pay stubs in many cases. So it was perpetually feeding itself this whole idea that the market would forever go up. And so the fact that the fear of missing out was generating the demand that was being caused outside of just the normal demand for housing. So everyone became a speculator. Everyone wanted to get in on the business of flipping homes or buying, holding, and selling, right? And that house of cards eventually came crashing down. And so today, it's nothing like that. The end user of homes these days is the occupant, right? There's not much speculation or flipping activity going on. It's always there. It's going to be a part of every market, but it's not the overwhelming part of the market that we're experiencing right now. The end user is the purchaser, which is making a huge difference. All right, number four, supply of an item or a service increases dramatically. Okay, so again, we'll stick with housing here. If you go back to the housing crash 15 years ago now, supply was really high. We didn't have a supply problem. There was plenty of new homes for sale. New construction was at some of the highest levels it had been ever. In addition, you had plenty of resale homes on the market. So again, you go back to number three, the demand being artificially generated, and you had the mortgage industry creating the demand, even though there was an increase in supply. That should have put downward pressure on prices. Thus, the bubble was created that eventually burst, and we all know what happened there. That's not happening right now. Okay, supply right now is incredibly low. So reference the blog post that I put out recently where I go and talk about what supply is. I mean, we're still running right around 3 months, 2.8 months nationally. Here in Frisco, Texas, we're under a month. In Southern California, they're right at a month. And remember, it takes about 6 months worth of supply for the market to be considered balanced, favoring neither buyers or sellers. And we are absolutely nowhere near that. And number five, demand for an item or service is impacted by an outside market dynamic. Okay, so what would be an example of that? So think back a few years when the price of oil skyrocketed. What happened to demand for Hummers and large SUVs? The bottom fell out. There was nothing wrong with those vehicles, but the demand for those vehicles disappeared based upon what happened in the oil industry and the price of fuel skyrocketing. What's the equivalent for the real estate market? Mortgage rates. So mortgage rates are what can do it. They're hand in glove with real estate and demand for homes. If mortgage rates get too high, it will negatively impact demand. But again, we need to keep this in somewhat of a perspective. So right now, rates have been at historical lows, and although they are projected to increase, they're still only forecast to increase to about 3.5% by the third quarter of next year. That 3.5% is still substantially lower than rates we saw in 2016, 2017, 2018, 2019. So they're still exceptionally strong mortgage rates or exceptionally good mortgage rates, which shouldn't have an impact or take a lot of demand out of the market. That demand should still remain strong based upon a 3.5% mortgage rate. But what about foreclosures? What about forbearances? We've heard that quite a lot. And the fact of the matter is, the foreclosure wave, the tsunami of foreclosures we were supposed to see, never materialized. It hasn't happened. And again, please keep in mind that foreclosures are a part of every single market. If you go back prior and you look at 2017, 18, and 19, there was an average of about 290,000 foreclosures a year when you average those years out. Okay, in 2020, there was 129,000. In 2021, so far, there's been 19,000. So right now, they're not happening. Yes, there has been a moratorium on foreclosures, which is why those numbers aren't substantially higher. But let's take a look at that. As of right now, the total homes remaining in forbearance is 1.24 million homes. A lot of properties, I understand. But how many of those properties have less than 10% equity? That 10% equity is a key number. Because if a homeowner has 10% equity, in most circumstances, you can sell that home, pay all of the closing costs, and move to a new home and still not go negative. Okay. So of that, only 7% of those 1.24 million homes have less than 10% equity. That's a potential of 86,800 foreclosures. If you add that to the 19,000 foreclosures that have already taken place this year, you're still at 106. Remember, in 2017, 18, and 19, we averaged 290,000 foreclosures. So what foreclosures that do come to market, and there will be some, are going to be absorbed based upon the low supply and high demand that we have currently. So again, are we going to see a softening of price increases? Yes, I absolutely believe that. I think the craziness of the market is going to back off. I think we're going to see a tapering of price appreciation and things slowly start to return to more normalcy and not be absolutely insane crazy. But the latest forecasts that have come out show that prices are expected to continue to appreciate not only next year, but in 23, 24, and into 25 as well. Again, no one has a crystal ball, and you need to make the best decision for you. But hopefully this information helps you provide something that's not based on fear, and it's not based on my opinion. It's based purely on what the data and the numbers are telling us right now. So if you'd like to see any of the slides or the information or the references to what I've explained in today's video, please go ahead and visit my blog. I'll put a link to it in the description right below this video. And as always, if you have any questions, please don't hesitate to reach out. I'd be more than happy to talk to you. You can reach me at 888-447-9650.